Hello and welcome to our latest podcast episode titled Investment Property Loans, Understanding DSCR Loans Explained in 2023. In this episode, we will dive into the world of DSCR loans, which are designed specifically for investment properties and provide a great option for those seeking investment real estate. We will discuss topics such as DSCR loans, including LTV ratios, eligibility requirements, and the different property types that are eligible for such loans. We'll also cover details like minimum DSCR, fixed rates, ARMs, interest-only ARMs, and gift funds. We'll wrap up the episode by providing some helpful tips and tricks for finding the right DSCR lenders for your investment property needs. So whether you're a first-time investor or someone looking to cash out, this episode is for you. So sit back and relax and let's dive in the world of investment property loans and DSCR loans in particular. This is going to be an exciting episode and we'll see you on the inside. For those unfamiliar, DSCR, debt service coverage ratio, loans are specifically designed for investment properties and the loan amount is calculated based on the property's projected rental income. These loans are ideal for first-time investors, those who need cash out up to $750,000, and those that do not qualify from an income standpoint like you would need for traditional loans. One significant advantage is DSCR loans, you can go as high as 85% on the purchase price on a rate and term refinance, 80% cash out refinance, 75%. Warrantable condos and unwarrantable condos sometimes take a haircut. Unwarrantable condos, maybe 65%. Credit scores as low as 620. DSCR loans are available for a bunch of different property types: single family, attached, PUDs, condos, low and high rise, site condos, townhouses, 2 to 4 units, and sometimes multifamily properties up to 12 units. Minimum DSCR is 0.75. You're going to get a haircut on that, as well as rural properties. Some DSCR lenders won't lend on rural properties, but if they do, it's about 65%. Some lenders use projected income for short-term rentals, while others only consider lease-up properties. Some have standard 3 to 5 year prepayment penalties, while other lenders offer prepayment penalty buy-downs. And there's also a program out there which is a 1-year hybrid product, which is a 1-year prepay fixed for 5 years. So sometimes that's the best option. So depending on your strategy with the property, there's many options. And oftentimes, we also do bridge financing for rent-ready properties. So you can acquire a property with no DSCR requirements. You can go in and rent the property out as a STR or a corporate rental and then season it, get proof of income either through Airbnb or VRBO, and then you can either refinance conventionally or take it to a credit union or bank, commercial division. Gives you options, so sometimes the bridge product is very useful as well. The bottom line is all DSCR lenders are similar, but yet different. They have different boxes. There's what I call the true business purpose lenders, which don't need to verify cash reserves. There's more of the residential DSCR lenders where they're more of a residential lender that also do DSCR loans. They're gonna look for 6 months or 12 months PITI reserves. So it's all over the place. So as you can see, DSCR loans are very advantageous for investors because a lot of investors or self-employed borrowers would never qualify from a DTI or debt to income standpoint. So the DSCR loans are definitely a viable option when buying investment properties. What some of our investors like to do, they like to do a fix and flip loan, or we call it a bridge loan. They fix the property up and then they stabilize it either as a short-term rental, long-term rental, or corporate rental. And then after 6 or 12 months, they refinance into long-term debt. Now with rates for DSCR loans not being super advantageous right now, although they're coming down a little bit right now, we also look at the bridge loan where we can write those for 12, 18, or 24 months. So DSCR loans, bridge loans, these are all great vehicles to acquire real estate. What I really love to do personally when I'm buying properties is buy something under market value, get a bridge loan that gives me up to 90% of purchase and 100% of repair costs, fix the property, tenant it up, and then season it for at least 6 months and refinance at new appraised value into a DSCR loan. It's really a BRRRR, as everybody says, the BRRRR, the acronym BRRRR. So anyways, I hope you enjoyed this episode regarding DSCR loans in 2023. It seems like there is more and more lenders coming into the DSCR space. There's lots of programs out there. There's lenders that love doing STRs or short-term rentals. There's some lenders that aren't that good. But what we do here is we assess your particular needs. Where's the property located? Is it a condo? Is it unwarrantable? Is it a fixer-upper? And we figure out the best way to acquire the property, and potentially if you need a fixer-upper loan, we can do that and then refinance you into a long-term DSCR loan. So if you're self-employed and trying to go the conventional route and you found that it's pretty hard to do because everybody's questioning your DTI and they're only using 75% of gross rents, that's why you come over to the DSCR world. Also, not all lenders report to your personal credit report, so you can also find out if that particular lender is going to report to your personal credit report. Some of the business lenders only pull soft pulls, so just be aware of all these options out there so you can grow your investment portfolio. I'll see you on the next episode. Thanks so much.